Welcome, and thanks for taking the time away from the Lance Armstrong and Oprah Winfrey fiasco that's on at the moment overseas. So I'm sure there's lots to learn from there, but it doesn't help us make any money, does it? So the trading landscape in 2013. Let's have a look at how it looks. First of all, normal disclaimer, trading Forex and margin, and I'd like to add that when I talk about these things today, they reflect my views and some of the trades that I will make, but the topic and opinions are general in nature only. That's so I'm not giving any specific advice, which is a particular interest under Australian law. Okay, 2013 is shaping up very different to 10, 11 or even 12. In some ways, when we look at option volatility and options market, you'd say it's less risky, but in my experience, perhaps this actually makes it more risky. But when we're looking forward, it's too easy for pundits, strategists, people like me, prognosticators, to make predictions and then ignore them. Indeed, even so far this year, we've already seen that one of the big global investment banks has closed out a trade in the first couple of days of January. So I'm not going to talk about what's going to happen, but I want to talk about the setup for the market and the opportunities, because I think the setup for the market, particularly low volatility, is really important for where the trades are going to come from. And I think that this could be a year of lots of little losses and then some very big wins for some very big breakouts, like the big 10, the 10-odd big figure move we've seen in dollar-yen in the last couple of months. The 4 or 5 big figure move we've seen in Euro Swiss just in the last week. When you wind up an elastic band as tight as many markets are getting, when they break out really hard. So that, I think, is something to keep in the back of your mind when you're trading. One thing I will say, however, you'll hear lots of people saying, predictions are useless, that sort of thing. Indeed, the studies show that. But the important thing for us as traders is to understand why predictions are often wrong. It's because what predictors try and do is they try and predict where a price will move to, but also a time it will get there. Now, Heisenberg showed us with his uncertainty principle that you can't do that, and it's also true. But what is important, and this will be a theme that we'll see through today's webinar as well, it's important to know what the market's thinking. It's important to know where the data is printing, not in absolute terms, but more importantly in terms of where the market is expecting it to print, because that's when, as traders, we can get those moves. So let's quickly go back to 2012 and have a look at where we've been so that we can set up for 2013. Treasuries rallied. Not too many people thought that would happen. European bonds recovered after the terrible mess of mid-year, after Draghi promised shock and awe. The US dollar has succeeded to get off the canvas, but it's starting to fall again. Stocks kept on keeping on. Central banks are dropping cash from helicopters. That's a big theme right now as US markets hit the highest level they've been since 2007. Yield hogs dived into currencies like the Aussie. They bought junk and emerging debt, and that drove markets around the world. The world didn't end. I think that, for me, is the most important thing in what we're experiencing here in January 2013. A lot of pessimism fatigue from last year, and as a new year dawns, as it's clear that Europe is not going to blow up anytime soon, as it seems clear that the US economy is starting to recover, then markets are looking to the positive, not the negative. We've switched to a glass half full from a glass half empty. But the reality is that the economies of Europe, of the USA and of Japan remain weak, with massive unemployment problems, with moribund sovereign debt issues, and it really is going to continue to be a debt deleveraging cycle over the next year or so. But with volatility being dampened by central bank activity, what we've got now is that volatility is at levels we saw in the Great Moderation, pre-GFC. And as an adherent of the teachings of Hyman Minsky, I promise I won't turn this into an economics lecture, I get really worried, and in my experience, when markets get volatility, both actual and priced, washed out, that's a precondition for the next big moves. I don't know when they're going to come, but this is something to watch. Just like dollar yen, just like euro yen. And from my point of view, in my armoury this year, I will be paying close attention to my trend following signals. I always do, but specifically I think after a year or so where trend following hasn't really been that great, unless you're in some of the ags, or dollar yen more recently, or Euro Swiss just now. It'll come back to the fore this year. I guess the key thing for me in the setup is it's all about Europe, whether it's the euro and the relationship with CDS, whether it's CDS outright. The fact that euro didn't blow up is one of the key reasons why markets are moving as they are now, why Euro Swiss is rallying, why money's coming out of Japan. Japan's got its own problems, and I made a call back before Abe was elected, before we even knew there was an election, that I thought dollar yen was going to go to 100. I'll talk a little bit about that. I think in time it'll probably go to 150, but for this year the target's between 100 and 108. But Europe improving has been a big boon. Obviously, when I'm talking about Europe improving, I'm talking about from the point of view of the market's perception. Unemployment in Spain and Greece of more than 50% for people under 25 is appalling. The absolute level of unemployment in both those nations above 25% is terrible. The overall level of unemployment in Europe is terrible as well. But the market doesn't always worry too much about the economics, and it's moved on. So the themes. The big picture theme is that we are in a sideways market for equities. Now, it may not feel like that after the price action we saw last night, but Vitaly Katznelson put out a paper and then followed up with a book many years ago, calling it a bull market, a bear market, and a cowardly lion market. This is a cowardly lion market. There are many reasons to say why this rally will ultimately fade, not least of which is the economic performance and the ability of companies to actually hit their top line revenue or hit their profit targets. So from my point of view, I'm going to run with this bull market. I wrote about it on Global FX this morning. But when it turns, I'll exit those positions, because first and foremost, this has been my underlying premise. When I was doing the currency strategy thing, wandering around the world back in the late 90s, early 2000s, I believed that we were moving into a period of a sideways market. I completely missed the high back in 2007, got out far too early. But for the moment, and that could happen again now, but for the moment, the metrics to me of the global growth of this deleveraging cycle suggest that Vitaly Katznelson is correct and we're in a sideways market. Other people, however, think we're on the verge of a new bull market. This chart's updated for 2 days ago, so it doesn't show the rally last night. If you had a chance to look at my piece on the S&P this morning, you would have seen that it pretty much, if you draw the trend lines, it's been in a bull market since the low. It's been in a bull market since August 2011 as well. So it's hard to fight that. It's climbing a wall of worry, but at some point I think that it will turn around. But we can't fight the Fed, can we? If we have a look at the chart on the left here, what we see is that whenever the Fed balance sheet starts to increase, so stocks start to increase. Whenever the Fed balance sheet flatlines or goes down, stocks go down. And we get some more QE, market rallies, it stops, it falls. This is an interesting setup for the markets going forward. We know the Fed's going to take, or it says at the moment, it's going to continue this unconventional monetary policy until we get unemployment in the States to 6.5%. Is the market going to be strong enough in 6.5% to cope with the reduction of Fed stimulus? That's the big question for the market in 2013, 2014, if the US employment market recovers. Something to keep in the back of your mind. Okay, the question for me is this just New Year hype? The economic and market performance are disconnected, there's no doubt about that. Central banks are continuing to drop money from helicopters, and observed market volatility though, even though actual volatility prices are very low, it seems to me that observed market volatility might be increasing. And my main focus on a daily basis is foreign exchange. And when I see the type of moves for in Aussie or Euro Yen or Euro or Euro Swiss or Dollar Yen or lots of different currencies, it doesn't feel like a low volatility environment. We're getting big ranges every night. So that's really interesting. And I think what it could be suggesting, particularly when we look at Euro Swiss, particularly when we look at Aussie lagging, is that this risk-on, risk-off meme that's been such a big part of markets during the GFC for the last 4 or 5 years might be starting to break down. We might be starting to see the correlations that head towards one and the whole world was the same trade start to break down. And that's fabulous for us as traders, fabulous for people like me who look at 50 markets, because I'll be able to get real diversification in my trades. So that's something I'm really excited about. Also, perhaps as I mentioned, Euro, Swiss and Aussie, it could be that money's being deployed away. Now, that potentially suggests that this equity market rally continues to go on further. But as I mentioned before, the negative rhetoric's gone. And Abe is a real game changer. Now, my view that dollar yen was going to go to 100 was predated Abe. It was based on, basically, my view that Japan's lost its mojo. That corporate Japan in particular has lost its mojo. The demographics don't help. And that overall, over many quarters, dollar yen will head to 100 and through it. But Abe's intervention has accelerated that move, and likely it's going to be hard to stop once it gets moving. As we've seen, every time it pulls back, someone comes in and buys it. And of course, Euro Swiss, that's a 2-day old chart, so it's well. I know that's from this morning. I beg your pardon, but that for me is a key indicator as well. All right, the great disconnect. We don't need to talk too much about this. I've mentioned it, but basically, it's perceptions about the economy that are much more important than the actual data that's released. Now, what I do each week is I look at the Citibank Global Economic Surprise Indices. I've got all these on my Global FX database, which I share with my colleagues from Macro Business in Australia, and this is a really good indicator. It tends to be mean reverting. Now, of course, that makes sense because it's about expectations and where the data prints relative to the expectations. Much more important for a trader than is the actual level of the data. Chinese data was a bit stronger than expected today. That's more important than the actual level most of the time. And the reason it mean reverts is that people increase their expectations, then the data disappoints, and they wind them back and the data continues to disappoint. But that's something to watch this year too. Now, I talked about Minsky before. He wrote his financial instability hypothesis many years ago. And essentially what we know, and we know from any of us that have traded for the last couple of decades or more, know that low volatility often leads to high volatility. And this is the area where we're getting to now. We've got the VIX, everyone knows the VIX, the S&P. It's down at levels last seen in the Great Moderation. And options desks around the globe, from what I'm hearing, have been continuing to lose money by trying to buy vol, and it just keeps being dampened. Largely because vol tends to spike more in fear than in hope, and I guess that's reflective of that 04 to 07 period. And so perhaps we are going into a very low volatile era. But I guess the question is, merging economics with trading, is do you really believe that the global economy is less volatile, or as volatile now as it was pre-GFC in that Great Moderation? I don't think so, so I don't trust it. But when we look at euro currency ETF volatility, it's at the lows of the GFC. When we look at gold ETF volatility, it's at the lows of the GFC. When we look at China ETF volatility, it's at the lows of the last couple of years. And crude oil volatility is at the lows of the GFC. So for me, we are starting to wind this elastic band up too much. I've said don't fight the Fed. There's a big caveat. I don't believe this low volatility era is going to survive. I'm going to have to trade it as if it is, but it's going to colour the way that I'm approaching trades this year. I know that this year I'm probably going to make a lot of small losses trying to buy breaks, but overall, just like dollar yen, just like Euro Swiss, we're going to see some big breaks. So these are my big calls, some of which look silly given what's happening at the moment, but this is the trades that I like for. Well, it's not exclusive, there's probably 20 trades I like, but these are the top ones. Dollar yen to 100, I've talked about that. Euro US to 138 plus is starting to become a crowded trade. Lots of people are on that one. Lots of big investment banks, but as I said earlier, if fears of Europe have gone away, then that should rally. Now, of course, it would be normal if the last 3 years have been any guide that around April or May we'll all get worried about Europe again, but that may not be the case. A weaker yen and a stronger euro equal a higher euro yen, so that's on track. I think if you've got the ability to strangle the Aussie using options, that's going to be a great trade. The Aussie has been the darling of FX land for the last few years. It's been the least ugly of all the global currencies, AAA rating, solid economic growth, high interest rates. But it was a safe harbour, and if things are starting to get rosy, then money will naturally not flow to the Aussie. It might go to other markets, and other markets where people are more comfortable. I'll show a chart of the Aussie a little bit later, but it's pretty clear that it's in a 95, 100, 600, 810 type range. Options volatility is really low. Buying for a break of either side of that range might reward over the course of this year. My gold call is going to be wrong unless or until equities turn around. So while we've got this benign equity environment where they're rallying, I'm wrong on gold and silver for the moment. But to be quite honest, gold has been in a sideways market since August or September of 2011. Silver's wedging itself into some sort of response, and I'll go with either side. But I do favour, and I have been suggesting for many months now, that over multi-quarters gold's going to fall. I know today that Goldman Sachs put out a piece overnight saying that they think gold's going to 1,200 in 2018. That probably suggests I'm wrong, but I shouldn't be that cynical. Nikkei and the yen are the same trade, so if dollar yen's going to go higher, then Nikkei also is going to go higher. On the S&P, I know I've said don't fight the Fed, but I think that it's probably going to make its high below 1520 on a technical basis and then turn. And as I said, options. Vol's really cheap. You might be using it. If you like to trade shares, I like Apple quite a bit lower on a technical basis and some fundamentals over 2013. Okay, low vol, we've talked about that. The specifics, this one here is a much is the wake-up call. The bull he's having a rest, he's keeping going, we're going to go up and down for a while, and then at some point volatility is going to break out. Now the big breakout, of course, has been dollar yen. We can see here that the big downtrend for the entire course, I guess, of the GFC has broken out. Abe's changed the rules. He's going to blow up the Bank of Japan. He's going to blow up the Japanese GDP. He's going to blow up inflation, and he's going to get us all focused on the fact that Japan's demographics and Japan's debt position are appalling. So we've got a moribund economy that's ageing. They're spending a lot of money on themselves in terms of that ageing population. They have no appetite for higher taxes. They have no appetite for a higher tax regime, and so dollar yen has turned up. So when I look at my trading chart, and it's interesting, I guess, for those who don't read the daily report that I put on FX Street every day, to talk about the systems that I use and the setup. So we're looking at dollar yen monthly here. So we see that it has formed its low. It's broken through this double bottom on a monthly basis. My MACD is about to head into positive territory. We've got a 200-week moving average up here at 200, and from where I sit at the moment, we've got a lot of clear air in that region, which is where we're going to head higher. So the key thing, the way that I trade, is that if you were to look at that chart there, is exactly the same setup as my daily charts and as my weekly charts. I believe in a very Mandelbrottian manner that if you take the time scale off a chart, you can trade the same system on that chart, and so that's what I've got. So as you can see up here, it's dollar yen monthly. It goes back to December 1990. So I think the yen's fall is a no-brainer. and that will drag the Nikkei higher. At the moment, the call is that Nikkei needs to close above at or around the highs of this month to kick on. But with dollar yen breaking higher, I think the Nikkei is going to get dragged higher as well, and I'd be expecting it to push up a bit higher. Where is it this morning? So it's up slightly today, and I'd expect that that to continue once again. Excuse me with the Wall Street Journal. So euro, and I've got the euro decimal point in the wrong spot there. Apologies for that. This is the euro US dollar weekly. Goes back to January 2011. I don't like the euro. I can't understand why the euro isn't at 115 or 1, given all the issues it's had. But I never let my rhetoric get in the way of my trading positions, and as you can see here, it's a clear uptrend. It's continued to go higher. It's finding a little bit of difficulty below 134 for the moment, and really does need to push on through that and then on through 135. Otherwise, we're going to see a bit of a consolidation. But I think it looks like it's heading to 138. Here we've got our reverse head and shoulders. So if you do get through that 135 region, you are going to see quite a nice sharp rally, and that's certainly one from a breakout point of view that I'll be trading on. Once again, that's euro weekly. This time going back to September 2010. Dollar index. I don't really like to talk about the dollar index. That is not good, sorry. Let me go back then. Alright, where are we? Okay, so that's euro yen. Hopefully you can see that. Euro yen weekly with a target around 140. I did push through that. It's looking like it's slightly overdone on the basis of the weekly indicators. The MACD is a bit too high, but it is up through its 200-week moving average. Mr. Administrator, could you please advise if you can see that properly, please? Then we've got the Nikkei, so we're looking for 14,000 plus on that. As I said, the chart there is for, from a technical point of view, if Nikkei can close above this high for the month. Oh, excuse me, guys. Okay, what can we see now? This is suboptimal. I do apologise. Can you see, Mr. Administrator? Yeah, okay. Okay, all right. Okay, I'll flick back through the charts because most of the other things I talked about. My apologies. It seems that for whatever reason, I've got two screens. I've been seeing what I thought you were seeing, but oh, what a disaster. I apologise for this. Okay, dollar yen, the trend's broken, so you can see that there. 108 is my target, as I mentioned before. My MACDs are about to go positive on a monthly basis, and there's a lot of clear air there up to 108. Euro yen, as I mentioned before, 140.30, possibly looking like it's overdone at the moment, but like euro, it has got a lot of upside potential longer term, even if it is overdone. Nikkei, I've mentioned that a few times, so there's the chart that you can see. It's heading higher, and euro, as I said, to 138, which is not my favourite, but that seems to be where it's going to go. So the euro head and shoulders, is reverse head and shoulders, I should say, is pretty clear. Oh, this is not working. I apologise for this. I have no idea why you are seeing something different to what I'm seeing on the screen. This is most frustrating, and I apologise. I'm sure it's frustrating the hell out of you. So, dollar index, head and shoulders. That's analogous to Euro's 135 level. If that breaks, then this whole rally for dollar yen for the moment is shot, and we're looking at 74 or something like that. That would be indicative of a big equity rally, which would mean that I am completely wrong on that front, and would also probably put more money in towards the Aussie dollar. Okay, can you see this chart here, which is a chart that I've delabelled so you can get a sense of where one of my calls has come from. What I'm looking at here is an index of a chart, and as I said, I have a very Mandelbrottian approach, or fractal approach, which is where I strongly believe that you can take the timescale off a chart and you can then get a feeling for what's going to happen. So if I look at that chart there, I think, well, this is a market that's gone nowhere, broken out, had a good run and is consolidating. It's a gold chart. And I think, when I look at that, I've got a downtrend starting, I've got a bottom, I've got a wedge, potentially bullish, of course, but equally I think this is a chart that needs consolidation. And as we see at the moment, gold is in the midst of a mini downtrend that it's been in since September. It's tried but so far failed to get through the bottom of this massive multi-year uptrend it's been in. It traded down through it, but it has not closed below it on a weekly or a monthly basis. And on that basis, you have to say the uptrend's still intact. And also on the basis that if equities are going to continue to rally and we see this strong move away from or into equities and into risk, then I'm going to be wrong. But for me, when I look at that chart, unless we see gold get up through 1763 or something like that, then I would be looking at a further consolidation and then a move down to 1520, something like that. Silver's had a round trip from what I can see. Silver, back in the 80s when the Hunt brothers had the silver cornered, we had that strong move, and then obviously the corner was ended and it went nowhere. Traded sideways, under $10 an ounce for a long time, and then started to rally with gold. In many ways, its technical outlook is even worse, having made a very strong high and then in a pullbacks in train. But like gold, it's wedging itself into a resolution here. It's up a bit this week, once again the weekly chart. But if it breaks, I guess if it breaks through the sort of the $34 range, then I'd have to say that the breaks to the top side, not the downside. But a lot of this is obviously dependent on what happens in equities. And I guess if you can't find the Fed, then I'll have to put my calls for euro and for gold and silver lower on hold for a while, because it's really just about the US dollar. If we look at the gold chart and we look at the yen chart, I've inverted the yen so you can get the relationship. In a broad trend sense, that's really what it's about, isn't it? It's about the US dollar. So to that extent, if we think about fundamentals, well, the US economy is doing better than the European economy. And at some point, is that going to reassert itself? I think it will. So that's why I'd say euro to 138, maybe 140, but to find some solid resistance there. Because I do think that from a fundamental point of view, the US dollar is going to be supported by the better performance of the US economy. And so in that sense, I do think, I'm not necessarily saying that the yen's a leading indicator for gold, but what I am saying is that you cannot abstract the US dollar out of this, and ultimately the US dollar should get stronger as the US economy does better than its European, Japanese, and maybe even catches up to the Australian economy. Speaking of Australia, Aussie US, the bottom of the Aussie range is the high of the old range. That post-float high we saw back around early '08 became the bottom, this 95, 96 region a number of times. So if you say it's in a box of 95, 96 to 108, 110. And that's probably the parameters. Shorter term, it's been above 105 for a few days. Yeah, I'm seeing that for some reason. I'm seeing the slideshow, but it doesn't seem like you guys are seeing the slideshow. So there's the Aussie box, and I would go with a break of either side. What's my favour? I think it's probably going to be range bound this year. I think that it is going to struggle to get the momentum unless or until we see another shock to the system. There hasn't been a shock to the system, for a few months now. Plenty of reasons. We could worry about the US debt ceiling, but do we really think that they're not going to pass that? They got through the fiscal cliff, so I'm pretty sure they'll get through the debt ceiling. They're more likely to have their fight over guns and that sort of stuff, US politicians. So in that sense, I'd be looking for Aussie to be range bound. And the key thing, why I'm not so bearish on the Aussie, the Australian economy is not as strong as it was. Interest rates are much lower than they were. The unemployment is not as strong as it was. Mining, in terms of trade's okay. The price of iron ore and that sort of thing's come back quite strongly. But in reality, the key is that institutions have been looking for alternatives. And to that extent, the biggest issue for the Aussie is actually the sunshine coming out in the global economy. Now, I'm not forecasting that, but when the sunshine does come out in the global economy, what I would suggest is that money will flow away from Australia. Certainly there's been a structural shift in people's demand for Aussie assets, but in truth, what we're seeing is money parked here because it's safe for AAA, it's relatively high interest rates. So if the Australian economy weakens and if rates go to 2% or lower, then we might have some issues for the Aussie, but for the moment, I don't think so. Now the equity market. 4-week moving average of initial claims. I would never have thought to use this initial claims as an indicator for the S&P, and I've got the S&P inverted. But it's something I saw Joe Weisenthal on Business Insider use quite a bit. He always calls it his favourite chart. So this just reinforces that US employment is a really important indicator for all of us to continue to watch. We know the Fed's watching it. 6.5% is the level where they're supposed to be taking out the extra monetary purchases. And of course, if they stop buying bonds, as we saw earlier, the market's going to suffer a bit. We even saw that earlier this month when there was rumours of the Fed stopping buying in 2013, not 2014. So the sustainability of the market rally is really going to hinge on what the economy looks like when the Fed takes that stimulus away. And on that, the jury's out. But for the moment, jobless claims last night were pretty good. So the 4-week moving average was down a little as well. So that's a good indicator to keep watching. Now the risks. Obviously, sovereign debt is still an issue in Europe. So is unemployment, and of course, social upheaval. I've been amazed that the societies are seeming to function. Australia's a long way away from Europe, and I know people tell me that some parts of Spain and Greece and Italy are not functioning too well, but from a societal point of view. But that re-emergence is a risk. Obviously, from an equity market performance, because it is still the key, the inability of companies to hit top-line revenue or profit numbers in a weak economy where aggregate demand's not as high as it was previously is clearly a key as well. And of course, as a trader, if we really are heading into this low vol environment, we're going to have to play ranges, and that's always a fun strategy until it doesn't work. But so that's going to make it harder to make money if we are. As I say, I think ultimately we'll break out of those ranges and get some big trends. But that's a risk in terms of our pocketbooks, trying to trade those ranges. And for someone like me who's going to buy breaks, if we keep getting breaks and then back inside and that sort of thing, then it's going to be difficult. China's glide path, of course, is important for everybody. That data today was okay. It was as we expected. So that's not too bad. And of course, we still have a very risky year. So the enemy of low volatility environments, as Minsky showed and as we've seen, is that we could get a black swan. Now, where could it come from? It's hard to see anything that hits us, but that's the nature of black swans, isn't it? It could be a European bank, it could be unexpected Fed withdrawal of stimulus. But the makeup of the Fed board is more dovish than hawkish this year. But it's still a risky year, as the chief economist of the World Bank said the other day. That's my last slide. I do apologise for the mess here. For some reason, I'm sharing monitor 2 instead of monitor 1. It's only my second webinar, and I apologise. I need to get better at this. I'm happy to take any questions if you have them on the outlook and on what's happening now, if you would like. You can probably see my Aussie chart there. That if we get down through this 104.90 region, it's probably going to have another bit of a move as well. And we're suffering on all the crosses on that basis as well. Yeah, it's 40 degrees here, and Ivan, who's our administrator, made me turn off the fans because they were making too much noise. And thanks, Don. Yeah, you're right. I've obviously got my 1 and 2 screens back to front, so I didn't. I was sitting here looking at the slideshow, thinking you guys were too. So I apologise. What I will do is I will post the presentation on www.globalfx.com.au, and you can access it, pick it up there for all the other stuff if anybody's interested. So I do apologise. I'll post that in about 20 minutes or so. No, there's no aircon backup in this room. My office is separate to the house. And it's my pleasure. Once again, I apologise. It'll get better for the next one. I'm hopefully going to do these sorts of things every 3 months or so in terms of big picture outlooks and maybe some more timely trading stuff every week or fortnight to keep people up to date. So obviously I'll get better as I do these things. So apologies again. What am I in at the moment? Dollar yen. My indicators are. Where's the dollar yen chart? I'll bring it up now. This is my biggest trade. Largely what I do is I trade breakouts and I use a moving average to help keep me in that trade. Dollar yen has not, this is largely where I reduce positions, and dollar yen has not come back sufficiently to reduce the pyramid. So dollar yen, not on this, but the move in Euro Swiss earlier in the week got me moving as well. Luckily I was out and I missed my signal at 15.35 to go short gold, but I'd have to put my hand up and say I would have lost a lot of money on that one. I was looking to buy the break of, sell the break of 15.35. Oh, sorry, wrong one. 15.35, which I thought was signalling the big, deeper move. But obviously that didn't occur. But I've got to put my hand up as that would have been one of the trades I would have been in. This move down here. 16.35, I beg your pardon. That would have cost me $50. Stock would have been hit out on that one. But they're the big longer term ones. I got long US SING here. I thought it was going to do a bit of a dollar yen for me, but it's come back. I'm still long, but if it gets much lower than where it is now, I'll be cut out. The level for me now is that low from last week, which is about 122. So they're the main trades I've got on now that are sort of more medium term. The shorter term ones, I just tend to use my hourlies and my 4 hourly charts to help inform me. That's why when I do the report, sometimes I'll have the 4 hourly charts, and I might say that based on the 1s or the 4s. I've always found that intraday stuff I like to use 1 hours with 4 hours overlay, and you'll see here yesterday I was writing that euro, if it went through the lows, should run down, and you can see the setup here. Today I've basically said that if 134.05 gives way, I'll go long euro. So that's the two levels I'm looking at for euro today, tonight. And of course there's a holiday in the US on Monday, so late early morning my time tomorrow might be interesting for a move in that one. So we'll have some orders in on that one. The trade I didn't talk about today, which I like a lot lower. I'm going to put out a piece about this either this afternoon or over the weekend. Is I like sterling a lot lower. I like it probably down to 158.20, something like that. I'm actually short sterling on the break of the bottom of the range here. It got very uncomfortable yesterday when it rallied back up to 160. But this, I think sterling's under a lot of pressure, and obviously euro sterling is rocketing. But I don't tend to trade euro sterling. So that's where I am at the moment. They're my main trades. I forgot about sterling. Apologies for that. Okie doke. Well, if there are no other questions, I'm going to go off and give myself an uppercut for doing a hopeless job of presenting. But otherwise, thank you for your attendance, and good luck trading. And hopefully, I've helped in some of the stuff we've talked about today. Yes, it is beer o'clock. Bye, everyone.